Hello friends, today through this video we will try to have an understanding of the basic concepts of lease accounting and the international accounting and financial reporting standards which affects lease accounting. I would like to remind you that this video is intended to have a basic understanding of lease accounting, and if you would like to know this in detail, then you will have to carry out your own research or refer articles which explains this in detail. I would also like to express my gratitude to IFRS.com, corporatefinanceinstitute.com and IASplus.com, from where I have gathered information on lease accounting and the lease accounting standards. So shall we start? So what is a lease? A lease is an agreement whereby the owner of an asset, who is known as the leaser, transfers the right to use the asset. So he has the right to use his asset and he transfers it to another person who is known as the leasee for a specified period of time, say a year. And of course, the leasee has to compensate the leaser for the use of this asset, which is normally known as lease rentals. So we'll consider some examples on leases. Now Mr. X leases residential property from XYZ real estate company, which is a common form of lease. Here Mr. X is the leaser and XYZ real estate company, Mr. X is the leasee and XYZ real estate company is the leaser. Similarly, ABC company leases equipment for business use from PQR equipment rentals. So here ABC company is the leasee and PQR company equipment rentals is the leaser. Now, this question may come to your mind. Is there any major difference between a lease and a rental agreement? A lease is basically a kind of rental agreement, but for a longer period, and hence the terms and conditions of the agreement is applicable throughout the lease period. These conditions can't be revoked in the short term without the consent of both the parties, that is, both the leaser and leasee has to agree if any terms of this lease has to be changed. So this safeguards the interest of both the parties involved in the lease. For example, situations such as sudden hike in rent by landlord or immediate vacation of the property by the tenant can be avoided through a lease agreement. Now we will talk about a different topic. However, this has got relevance on lease accounting. So, what is off the balance sheet method of accounting and why do companies perform this for leases? Off the balance sheet method refers to the assets, debts, or financing activities of a company that are not presented on their balance sheet. So, why should a company do that? Why should they not show their assets or debts or financing activities on their balance sheet? Companies generally adopt this practice to avoid breaking their loan covenants or to have a better appeal of their financials to the current investors or the prospective investors. For example, in the past, leasing an asset instead of buying generally helped company to have a better debt equity ratio and better asset turnover ratios, as the asset and liability are not recorded in the balance sheet, and this might help companies to attract those or investors. So, how do we prevent such creative accounting techniques? Normally, such creative accounting techniques are prevented through accounting standards or financial reporting standards, which are to be followed strictly by companies while accounting. So, are there international accounting or financial reporting standards relating to leases? Yes, we have IAS 17 and IFRS 16. So let us start with the initial standard on leases, that is IAS 17, and then we will go through the latest standard, that is the IFRS 16. IAS 17 leases. IAS 17 leases categorizes lease as two types. One is finance lease and the other one operating lease. Now, what is the difference between a financial lease and an operating lease? In a lease's perspective, a financial lease is like buying an asset, and an operating lease is similar to just a rental agreement. That is the difference between both. So, a finance lease is like buying an asset, and a, an operating lease is like a rental agreement. Now, how do we classify a lease as a finance lease? Following conditions generally qualifies a lease as a finance lease. If ownership of an asset is transferred to the leasee at the end of the lease period, then it's a finance lease. If lease term is for a major part of the asset's economic life, then that is a finance lease. For example, we have leased a car for 9 years, and the life of this car is for for 10 years. So we our lease period is almost 90 percentage of the life of the asset. So in this case, we can qualify this as a finance lease, means we can consider this as a finance lease. Now the next condition, if the present value of minimum lease rentals is equal to the fair value of the asset, then it's a finance lease. So you know that um, the value of say $1 after 10 years is different from the value of dollar in current year, right? Whatever you can buy for $1 now cannot be bought after 10 years with $1. This is due to a lot of other factors such as inflation, um, and time value of money. So it's a broader subject, and that has to be covered in a different area, means like financial management or somewhere. You can just try to learn this. Okay, so the present value of so we will consider now, um, we will ignore the time value of money now. Say a lease is for 9 years and you're paying a $10,000 every year. So the lease rentals for the 9 years become 90,000, and if the market value of the asset right now is 100,000, so your lease rentals are 90,000. It is almost 90 percentage of the value of the asset. So this qualifies as a finance lease. Next condition: if lessee has the option to purchase the leased asset at a value substantially lower than the market value at the end of the lease period, then it's a finance lease. So if the lessee has the option to buy the asset from the lessor at a value which is expected to be substantially lower than the market value at that time, so that means the lessee will obviously go and exercise that option, then this qualifies as a finance lease. Now, the next condition: if a leased assets are of specialized nature that only lessee can use them without much modification, then it's a finance lease. These are the above mentioned are the general conditions for qualifying as a lease as a finance lease, but these are only general conditions, and concept or practice of substance over form prevails here, and this has to be considered while categorizing a lease as a finance lease. Now, any lease which is not a finance lease can be considered as an operating lease. So that is how we categorize a lease as a finance lease and an operating lease. Now, we will discuss about the finance lease accounting entries in leases books as well as leaser's book. At the start of the lease, in leases books, we will debit the asset, that is an equipment or a building, then credit lease liability. This amount should be the present value of minimum lease rentals to be paid during the lease period. So the present value of the total lease rentals. Now, in the subsequent periods, the following entries are to be passed. 1. Debit depreciation and credit accumulated depreciation. And this is for the depreciation charge of the asset which is recognized at the start of the lease. Then the second entry is debit lease liability, debit finance lease interest, and credit cash or bank. And this entry is to be passed at the time of paying the lease rentals. Now in leaser's books, at the start of the lease, will debit finance lease receivable and credit asset that has been given on lease. And this amount should be the present value of minimum lease rentals to be paid during the lease period. Again, subsequent periods we have to debit bank and credit finance lease receivable and finance interest income at the time of receiving lease rental from leasee. Now we'll move on to operating lease entries. In leasee's books, every year we'll debit lease rentals which is being paid to the leaser and credit bank or cash. Similarly, in leaser's books, we will debit cash or bank and credit lease rental income at the time of receiving lease rentals from leasee. Now we'll move on to IFRS 16, which is the latest international standard on lease accounting. So why do we need IFRS 16 when we already have IAS 17 leases? IAS 17 allowed some leases to be classified as operating, although they are long term in nature or are non cancelable in the short term. This enabled companies to enter into leases which were technically operating but by nature were financial leases. IFRS 16 take out these discrepancies and require leases to be classified as finance leases and appear in balance sheet. What are the major changes with IFRS 16 from IAS 17? The major change with IFRS 16 from IAS 17 is for the leasee's accounting books and not for the leaser. That is, if there is a lease involved, even if it is an operating lease, leasee need to recognize this in the balance sheet, similar to finance lease accounting under IAS 17. So the main thing here is to find out if there is a lease involved in or not. IFRS 16 provides a detailed guidance to determine if there is a lease involved in a contract. The foremost thing is to look at and identify an underlying asset. So the first question you need to ask under IFRS 16 on an arrangement is that whether there is an underlying asset occupied by the leasing. Now let us go through two different examples to understand the above concept in detail. One arrangement is a lease agreement and the other one is just a service agreement. So the lease arrangement has to be recognized in the balance sheet, whereas the service agreement need not be. So the first example is that ABC company occupies 1,000 square feet space for storage of goods in the building of Mr. X for USD 5,000 rent per annum. But Mr. X, who is the owner of the building, decides in which room he has to store the goods based on the availability of room space. So, in this arrangement, Mr. X has full authority over the space to be utilized, whereas ABC company just takes a service from Mr. X. Hence, there is no underlying asset for ABC company and no lease to be recognized in the balance sheet. Now in the second example, ABC company occupies room number 12 with 1000 square feet in the first floor for storage of goods in the building of Mr. X for USD 5000 rent per annum. This is specifically allotted for ABC company and Mr. X doesn't have the right to change the storage space. So apart from the above example, the major difference between the earlier example and the current example is that in the first example, Mr. X had all the rights to decide where to store the goods. So that was a service arrangement. But in this case, ABC company has the right to decide how to store the goods, and they own this. Um, they no, it's not owning. They occupy this room number 12. Like it means that there is an asset available for ABC company under this arrangement, and this qualifies as a lease, and ABC company has to record this in their balance sheet. Another important point to note is about the service element in the lease contract. Some lease agreements may contain a service element too, such as a cleaning service or free reception services. In this case, the lease rental has to be classified between the lease part and the service element based on the standalone market prices. For example, in the above example number 2, there is an additional service element provided with the room space which has a standalone market value of USD 2000. Property standalone market rent is USD 4000. Now, the above lease agreement rental was for USD 5000. So the lease rental that needs to be recognized in the balance sheet has to be calculated as follows: USD 5000 into 4000, which is the property standalone market rent, divided by 4000 plus 2000, which is service elements standalone market value, equals USD 3333, and the service element is calculated in the same way as USD 5000 into 2000 divided by 2000 plus 4000, which is USD 1667. However, it's not that straightforward, as it is very difficult to get the standalone mm, prices in most of the situations. As discussed earlier, above accounting treatment mentioned in IFRS 16 is for leases, and for the leases there is no much change in accounting under IFRS 16 from IAS 17. Finally, as you all know, the above details are just a summary of the major points covered in IAS 17 and IFRS 16, and actual treatment could differ, and it is based on the particular situation that is under consideration. So that's the end of this video. Thank you all for visiting this video, and hope you have enjoyed this video. Thank you.